Good morning, everyone, and welcome to our weekly webinar once again. Delighted you could join us for this sort of 30-minute fast-moving educational and informational webinar. I'm David Johnson. Most of you know me as the CEO of Leo Crowdfunding, and my co-host, Mr. John Corey. So how are you, John, this morning?
I'm good. Looking forward to today's talk. I'm a bit of a numbers geek when it comes to this stuff, as being a programmer in my prior life.
Yeah, I'm looking forward to listening to yourself and our guest bounce ideas back and maybe quiz each other on some of the fine points of property investment. It promises to be a good one. So before we dive in with our guest, property market update, of course, the news keeps throwing us fastballs and curveballs. I think the interesting one, John, that caught my attention was this court threat for some of the big developers. So this is Taylor Wimpey, this is Barratt Homes, and they are, well, potentially being taken to court over how they've set up some of their leasehold agreements. Have you heard of this, or are you aware of the details?
I'm aware of it in sort of from the public press, which it relates to houses. So it's not city center flats, it tends to be houses where instead of selling freeholds, they sold leaseholds. And there was a ratchet in the contract for how the underlying ground rent would go up, and it would go up a fairly significant amount over a long period of time. So in the first few years, it seems quite minor, but the compounded effect, which is actually quite relevant to what Iain will probably be explaining later, that the compounded return if you're receiving money, the compounded cost if you're paying money can become quite significant downstream, and that's what this is all about. A lot of the buyers didn't understand the implications of what their ground rents would be in 10 or 15 years, and in the extreme, it makes the house unsaleable to a future buyer because the ground rent costs will be too high.
Okay. Well, the Competition and Markets Authority are now demanding an explanation from these developers. So it'll be interesting to see how that comes out. And I suppose the other big news that's positive for the property market, the government pumping quite a few billion into, I suppose, bridging the gap between the mortgage amount and then the amount required for the deposit. So it should allow more people to get onto the property ladder or make homes more affordable. So again, I'm assuming you agree with me that that's a positive move in the short term.
Yeah, see, again, this is one of those in the short term. It might be a great way for people to get on the property ladder. It may turn out well. If properties don't appreciate or if they were to fall in value, it could result in the government recording a big loss because these are essentially situations where the government's your JV partner in your home. And if the values go up, they get a piece of it, the government, and the value doesn't go up, then they possibly take a hit. And as taxpayers, we are the people funding this. So those of us that aren't taking advantage of it are the actual ones paying for it.
That's interesting, and really it's probably a follow-on from last week where mortgage deals were beginning to plummet, lenders were staying safe. The government's obviously reacted to that to try and get stimulate the market, which I suppose is a good aim. But as you say, these things all come at a bit of a cost, unfortunately. Okay, so let's move on then quickly to our topic for today. This is really part 2 of what we did last week, looking at buy-to-let as a strategy, and if this is a strategy that investors want to employ or fundraisers are wanting to raise funds for this strategy. It's really peeling back the layers of the onion is probably a good way of describing it. A lot of people just look at headline figures and really, John, jump in.
Let me expand this slightly. It's not just buy to let as in terraced houses or flats or whatever. It's any situation where you're buying to hold or building to hold. So it's the idea of having a long-term, building a portfolio. Buy to let being the biggest market that most people participate in, but it could be commercial property, it could be residential, it could be, you're building it from the ground up to hold it. So.
Yeah, okay, no, thanks for clarifying that. Okay, and right on cue, Iain has come on his camera and his audio. So good morning, Iain. Welcome to the call.
Good morning, guys. Good morning, everyone.
Good morning. So let me just introduce our special guest today. Absolutely delighted to have Iain join us. I know he does jump on these webinars from time to time as an investor just to see what's going on. So it's nice to have you on this side of the camera, Iain, today. So in terms of Iain's background and why we were really keen to get Iain on this topic, you can see there he's a Chartered Financial Analyst, and there aren't too many of them around the place. You don't bump into them every day of the week. So it's quite an exclusive achievement to be qualified as that. In his previous life, fund manager, professional career spanning, banking, asset management, etc. But what's more interesting to me is, of course, his experience in property investment. So over 20 years, he's been involved in this, in many cases, this type of buy and hold type strategy in numerous countries. And he's also been quite active on some of the property crowdfunding platforms. So a brilliant person to have on our webinar today. And Iain, we're really looking forward to getting stuck into this. And does anyone just comment on your background, some of the key achievements, and maybe expand slightly on what you've done in property?
I guess I started like most people, right? I didn't actually start out intentionally to be a property owner. I came in through the back door, basically. I had a career in progress, and then I had some spare money, and I was looking for somewhere to invest that offered better returns than putting it in the bank. And I guess that's how most people get into property investing, right? And then just snowballs for whatever reason from there.
Yeah. Okay. So what we're going to do is we've got a couple of slides here to let you explain how you would look at different property investments, and I'm going to let sort of John and you have a conversation over the next couple of slides. So when you want the slide turned, just you or John let me know, and I think that's the best way of getting the most value out of what you can bring. So again, to remind everyone, there's a Q&A box, so don't use the chat box. If you have any questions, doesn't matter how technical, throw them on here, and we'll try and get them in before the end of the call. And if not, we can even follow up afterwards. So put your questions or even comments into the Q&A for us. That would be a great help. So I'll leave it maybe to yourself, Iain, to kick off with the first slide, and then John, you just come in as you see fit.
Yeah, okay, thanks. So, yeah, internal rate of return. It sounds quite scary, but it's actually quite simple, and it's a lot simpler these days with Excel. You only have to put in a few numbers for your cash flow, and then it's a number that you can calculate quite easily. So it's not a number that should scare most people these days. So yeah, IRR, internal rate of return. Basically, what it's used for is valuing a set of cash flows. And usually you use it in a situation where those cash flows are a little bit unusual or uneven. And the example that we're using today is the Target 5 development, where there's a upfront cash flow into a project, and then before the end of the project, there's a big cash flow out. That will distort a lot of simple metrics. But with IRR, usually it's pretty good at capturing those sorts of unusual or upfront cash flows in both directions and giving you quite a sensible figure. There are a couple of
So why MIRR?
Yeah, so there are a couple of limitations to IRR, and this is what's brought out the MIRR, or modified internal rate of return. But well, there's a calculation problem with IRR, but that's only a minor problem these days because Excel allows for that. But two inputs that IRR doesn't allow for is one, the cost of capital, and two, the reinvestment rate. So looking at cost of capital, basically this can vary between projects. If you're comparing, one investment opportunity to another investment opportunity, they might have different costs of capital. The IRR doesn't capture that, but the MIRR does capture that. Then secondly, what the IRR misses out on is what happens to cash that's coming out of your project. So if you've got a project and there's cash returned to you, what happens to that? And that's where the reinvestment rate comes in with MIRR. It solves for this by assuming that you can reinvest the cash flow at something other than zero.
Yeah. In particular, in these days, if you're getting a bit of rent every month and it goes into a bank savings account at 1% or less than 1%, that'll be a much lower return than if it was not, if it was reinvested, which is what MIRR can help you identify.
Exactly. And it's actually quite misleading, because if you're an active manager of your money, you're probably not going to be doing that. The money will go into a bank account short term, but in the medium to long term, you're looking for another project. So assuming that that money is going into a zero interest paying account for long term is not a good assumption.
Should we go to the next slide?
Yeah. So sorry. So then just go back 1 second. So why are they used? And the question was, why should I use these rather than return on investment? And to be honest, you've got to have a good reason not to use return on investment, because return on investment is the gold standard. It's very easy to calculate. It's clean. It's simple, and it's also very intuitive. People will use this and they won't even know the formal name for it, because they just look at how much they're investing, how much they're getting back, and that's the return. And people widely use this. But the problem is you shouldn't use it when your project cash flows are unusual, and particularly in the case where you're getting money, and a lot of money, back sooner than when the project concludes.
Okay.
So here we have a comparison of scenarios. Basically, the blue one, scenario 1, is having your money in a savings account. The green one, scenario number 2, is the simple buy to let, where you buy it and hold it, in this case for 6 years. And then the red example, number 3, is the buy to let, which is being refinanced. So you're putting the money in up front, but then after a year or so, the project gets refinanced because for whatever reason, the development gets completed, and you can refinance and draw a significant portion of your investment back out early. So if we go back to the blue column and just look at the bank account example, we've just assumed that the bank account pays 0.5% per annum in interest, and then you can look down through the years, down towards the bottom left of the figure there, and you can see the initial investment of 100, and then every year you get back 50p. And then at the end of year 6, you get back your initial investment of 100, and then your final 50p. So then your return over those 6 years is £3. You divide it by 6 years, so that means your return on investment is 0.5% per year. And basically, if you calculate the IRR and the MIRR, because there's so few inputs into this calculation, they're identical to the return on investment. So then the second example, the column green, the buy-to-let example, what's changed in this example versus the first example is that you're now getting a yield, because you've bought a buy-to-let, and the tenants pay you rent every year, so that's your yield. And then we've also made an assumption that over time your property goes up in value. So you can see the two assumptions there in red. So the yield is 4%, and the capital appreciation we've assumed here is 0.33% per year. So then if you look down through the second half of that column, you can see the cash flows. Again, it's £100 initial investment. Then every year you get out £4, which is the yield, or the rental income. And at the end of year 6, it's assumed that you sell the buy-to-let. You get back your initial investment, plus the capital appreciation, plus the last year of rent. So that makes up 124. So 124 plus the cash flows minus your initial £100 of investment gives you a return of £44. Divide that by 6, and you get an return on equity of 7.33%. You'll notice that the IRR and the MIRR are quite close to this figure. It's because of the way that they're calculated and the assumptions that they're a little bit different. But because most of the big cash flows occur at the end, there's not too much distortion there. And looking to the third example in the red column, this is the buy-to-let with the refinance. What's changed in this example versus the second example of the buy-to-let is that we've assumed a refinance after 1 year. So we're assuming that you can refinance and take £70 out of your buy-to-let. So you started with 100, but after 1 year you can take out 70. So that leaves you with 30 in the project for the remaining 5 years. What we've also assumed is a reinvestment rate of 13.88%. And I'll come to why that's 13.88% in a second. So then if you look at the second half of that column and you look at the years, in year 0, you put in your £100 investment, but then in year 1, you get back £70 because of the refinance and another £4 because of the rental income. Then that £4 rental income continues for the next 5 years. And at the end of year 6, you get back the other £30, which is your initial investment. You get back £20 of capital appreciation, and you get your final rental payment of £4. So that gives you, sorry. So if you go back to, so then looking down at the return figures, it gives you the same return figures and the same return on investment. So the buy-to-let versus the buy-to-let refinance will produce the same return on investment, the same ROI. But importantly, the IRR and the MIRR are much greater. The IRR is 13.88% because you're getting a big cash return in year 1. And that's a big benefit because you can take that money and reinvest it. You don't have to put it into a bank account. You can take it out and put it into a similar buy-to-let and earn the same rate of return. And because that opportunity is available to you, that's why up above in the red, we've used a reinvestment rate of 13.88%, because that means that you can reinvest the money at the same rate again and again and again.
So the reason you use the reinvestment rate is clear, what you just said. Most people won't be able to do that because they won't have another deal they can buy because they need 100 to buy it and they only have 70, and they'll never quite get back to 100 until 6 years have passed. So is this a valid way to set the reinvestment rate?
Well, I think there's always going to be a little bit of lag. So it'll never be perfect. But the point is, it's not going to be earning 0 for the long term. I mean, it might be earning 0% or whatever in the bank, 0.5% for a short or medium amount of time. But in the long term, you should be able to accumulate enough money to get your minimum investment and go again.
Okay, so just almost to jump ahead, I'm not sure exactly where this is covered, but one thing you can do with crowdfunding that you can't do at normal buy-to-let is you can take less than the amount to buy the property, whatever your deposit is or whatever, and you can reinvest small amounts in other projects. So that's one way to achieve a reinvestment rate that's competitive with what you're already receiving. So if you were to run the math with 0.5 as the reinvestment rate, which is sort of the bank interest rate, you'll find MIRR is about half of what is projected there. And the magic, if you want to call it that, for crowdfunding is you have the opportunity, if it makes sense, if the deals stack up and you're happy with the due diligence, to reinvest even small increments, which will help will make a large compounded impact in your investments over time. Anything else on this slide, Iain?
Just for the viewers at home, I've got the original spreadsheet in front of me. I mean, I've got 13.88, but if I just change that reinvestment rate to say 10%, the MIR drops from 13.88 to 11.64. So that's the sort of, and if I then drop the reinvestment rate again to, like, say 7%, because there is a lag and it takes you time to accumulate your investment, it drops to an MIR of 9.96%. So the point is, you're going to earn a lot more in this example than you are in the simple buy-to-let, and then you're putting money back into a bank account when it comes out.
Yep. Very good.
Okay. So the advantages of using IRR. I mean, basically, it's an improvement over IRR. And also, it's useful because you can measure the sensitivity of cost of capital. It's not always going to be the case where you're comparing one buy-to-let in London to another buy-to-let in London. You might be you're comparing one buy-to-let in London versus a buy-to-let in Belfast, for example, and maybe you want to assign different costs of capital to those two projects. MIR disadvantages. The first one, I'd say it's harder to understand, and that's because there's more inputs, and as a result, it takes you more time to get the inputs together, and you've got to think more about the inputs as well.
So how many inputs are there?
I
think it's 3, right? Plus you have to have the series of cash flows.
Yeah, assuming you've got all the cash flows, you need an interest rate, you need a reinvestment rate, you need a
cost of capital, and then the series of cash flows. So IRR versus MIR, there's 2 more inputs, so 1 versus 3 in effect.
Yeah. So then,
when to use it? That's, I think, the big question that most of the audience would have.
Yeah. I mean, as an analyst myself, I don't usually use MIRR because to me it's in the middle ground basically. If I want to do something fairly quickly, I'll just use the IRR, and that gives me a pretty good idea of where the return's going to be. If I want to go so far as to model these extra things like the cost of capital or the reinvestment rate, usually that's a bit more of a prolonged exercise for me, and I'm usually going to put in other variables as well. So as an analyst, in my former career as an equity analyst, I would probably move to a DCF model, either a modified DCF or a full DCF, and I'd build it. And
DCF is
a discounted cash flow, and that's a further for this discussion. But basically, it allows you to model every single cash flow. And importantly, it allows you to discount back cash flows, so you get a present value of what you're investing in.
An NPV. we'll baffle them with acronyms.
Yeah, I think that's a good time just to kind of bring back into the room again and start getting into the fine nuances.
So what IRR and MIR are all about is a multi-year investment, and it can deal with the recycling of your capital. This whole idea that you put a bunch of money in, you take some money out after refinancing. So that's the classic buy-to-let scenario. So that's why these metrics should be used, as they're much more suited to what is actually going on, rather than just take 6 years worth of returns divided by 6 and claim that's your rate of return. And you could argue that some people talk about return of capital invested, or ROCE, capital, return on equity reinvested, that sort of thing. These are all kludges where they could just use this. It's a built-in Excel formula. It takes 3 inputs. It's not a big deal. So
yeah, okay. So
can I just reiterate? I mean, you really, as much as I love ROI, you simply cannot use it in this situation because you're not going to capture the full return of the project. You have to use something a bit more advanced to really give yourself the benefit of the upfront, in this case, the upfront cash flow out of your project when you refinance.
Yeah, I think that's a really good point you've made, Iain, a good place sort of to finish on that. A lot of people just immediately focus on the ROI, whereas if this is a long-term hold strategy, then that really isn't the best metric to actually analyze the project. Okay, one quick question before we move on. Someone asked here.
I'll actually use the next slide just because I think it highlights the point. It relates to the question.
Okay, can do. This one or the one after, you mean?
I have, where's the one with the cash flows in? That one, yeah, exactly. So
yeah,
this is a visual representation of what's going on in a project, right? And this looks like a normal buy-to-let. You put out a bunch of money, you get some money back and refinance. You have rents for a number of years and then you sell. This is exactly what buy and hold is all about. So Chris's question, David?
Yeah, so if I go back to Chris's question, it was, this seems to make so much sense to buy-to-let operators, but my question is, why haven't we heard much of IRR and MIRR in the past? So it's a fair question.
As the American, I'm going to put this right between people's eyes, because too many are dumb, okay? And they don't take the time to understand the math. They use false positives or false negative indicators because it sells deals if it looks good on paper. and if they can calculate it without thinking. This is, if you are a CFA or anyone else, you use the right tools for the job. If you're a contractor on a building site, you use the right tools for the job. You have to learn this stuff. It's not hard. Iain said it's like 3 inputs and a series of cash flows. Well, you should be doing that anyways. Now, this project highlights how we did this. Go ahead, David.
Yep. Okay. So Iain, thanks very much. I mean, stay on there, and might be able to bring you back in at the end if any other questions pop in. Let me briefly pivot then. So one of the reasons we've been focusing so much on this, educating people and getting people to see a better way or a different way to actually analyze deals properly, is because we have a series of deals coming on our crowdfunding platform that will use these type of metrics, or these metrics are the best way to analyze them. So our West Building project that we've talked about for a number of weeks is now view deal on the platform. So on the left-hand side is what you'll see on our homepage. On the right-hand side, you'll see this is a HMO mixed-use conversion in Worthing. The ground floor will stay commercial. There'll be a 3-bed flat renovated for professional leasers. Figures expected around about 11.7% gross yield. But this is a 6-year investment opportunity. So it's literally get in, help them purchase, then refurbish, then it'll be refinanced after a year, but then the investors will enjoy, as being shareholders of the SPV, they'll enjoy a share of the rent for the following 5 years, and then be bought out by the principals at the end of that. So many of you can remember both Tina and Andy, who were on our webinars in the past, very experienced property people down around the Brighton area, and you can read their whole profile, of course, on our pitch pages. Just to highlight then in the middle bit is they're purchasing this property for $245,000. If you go in and register and download the full document, you'll be able to see what that's actually valued at currently today. So you can do that bit of homework yourself and see the discount at which they've purchased. But all in all, with the renovation costs, purchase costs, etc., $407,250. Expected valuation $550,000. So by just doing the project, the SPV is creating about $142,000 of equity. Now the bank funding is in place. Target 5 are putting in a little bit themselves. But the key thing for our discussion is the bottom bit, and that is the projected MIRR for this is 13.44%. Again, always highlighting returns aren't guaranteed. This is an investment. Obviously, do your full due diligence, look at the information before making a decision. So, John, just what we're saying, this I think very clearly lays out. £100 goes in at the start. The end of year one, there's the finance returned, and then the property's rented the next 5 years, and then at the end there's a purchase back. So that adequately shows the cash flow. And for me, the interesting thing wearing my investor hat, John, is this idea of getting around 70% of my initial investment back after 1 year, but been paid on the value of the £100 I initially invested. I think that's just really cool in property investment and interesting for crowdfunding.
I agree. And this is actually the standard advice that people are given in all the training classes. Buy it, add value, refinance it, recycle your cash, move on to the next one. And this is an example where you get out 70% approximately of your cash and leave approximately 30% in, but you've created some extra value. So maybe all you're leaving is your profit. You'd have to look at the detail, but it's a repeatable process. And the magic of crowdfunding is if you're getting £3.96 a month, or sorry, a year, you can top that up and put in £100 in the next project. So you don't have to get 100% of your cash out to be able to put some money into a next project.
Yeah, and we have sort of done this on the minimum entry level of the investment, and we have lots of people who do that for education, just to understand the process, which is great. If someone was suited to investing more, and they did, for instance, put in 10,000, well, by taking the 7,000 that comes out after year one and reinvesting that in a project, and then 70% of that in year two and going again, they really can have that initial tranche of funds working in multiple deals, which I think is very interesting and exciting. So For those who want to look more detail at the project, you can go on our pitch pages. You, of course, have to register before you can download the offer document and read a very comprehensive, well-presented, professional offer document on this project. However, what you can also do is, if this is something you think you're interested in, you can actually record your interest. This is very valuable for Tina and Andy and the Target 5 team, just to confirm the level of interest there is among the investor base. So you can actually leave your email address, you leave an amount if you want to, that you might be interested in investing if everything checks out, and that just gives a good indication of where the project's at. There's also a form, which you can see there I've circled. This allows you to communicate with other potential investors and indeed with Tina and Andy directly. So you can ask the question, you can see other questions that are being asked, and particularly Tina, on behalf of Target 5, jumps on there and seeks to answer the questions. Really important part of what we do in crowdfunding. Multiple people asking questions means that everyone's seeing the information, and this is I think, John, this is a real key that people don't realize the potential of crowd validation when you're analysing a deal.
Yeah, particularly when some individuals have specialist knowledge, specialist skills. Maybe it's soils, maybe it's finance, maybe it's construction techniques, and they can ask very pointed questions about a project that others wouldn't even know to ask.
So following on from that then, just to finish off the webinar for today, the Target 5 team are actually doing a project webinar with us, and that's next Tuesday. So next Tuesday, the 15th at 7 p.m, Tina and Andy will both join us. They'll have some images from inside the building. It's going to be a very worthwhile look at the project. Again, great opportunity for you to ask questions directly from Tina and Andy. So there is the link. I'll just leave it there quickly if people want to take a screenshot of the page there. If you go on any of our social media outlets, you'll see it, and we'll probably also send an invite to all the attendees that are on this webinar, just to make sure that if you're interested, then you will receive that. So I encourage you, if this is, sorry, go ahead, John.
There have been a couple questions, particularly from one person, that relate to this project. I'd encourage you to post the question in the forum for the project, or attend this webinar in a week's time, where the principals for the project will be available to answer your questions. It makes it easier, essentially, for those questions to get answered by the people that have come up with the information, and then everybody else who might be considering investing can see the question, they can see the answer. So we're all benefiting from the fact you're asking such good questions.
Yeah, and I see the person's confirmed they're able to do that. So we'll allow it to go through the forum, and then everyone benefits from that, which is great. Some good questions there. So that is really the end of the webinar today. Again, anyone who is interested in speaking to myself or John one-on-one to view just some consultancy. I know, John, you have a number of clients who have come to you specifically about modelling this kind of buy and hold type structure for their projects. And it's certainly something I think is going to be more and more people will see this as a very viable strategy moving forward.
I think this is the main strategy most of us were taught. It's classically the strategy I use for buy and hold. I've done it for a few decades, and the ability to more accurately understand the cash flows and understand the compounding effect over time is really important. Like, it gets a little crazy as when people can refinance at 100% and you're getting an infinite return because you have no money left in. So it's understanding what the math is telling you, what the dashboard means.
Yeah. Okay. If Iain's still there, he can come off his camera and his sound if he wishes to have a goodbye. Iain, really appreciate you taking the time to come on today. Very, very valuable. The recording, of course, will be on YouTube, on our YouTube channel. Just go to Leo Crowdfunding, you'll see it there. And I think there'll be a lot of people, Iain, downloading that and getting their calculators out and looking at how you analyse that. But very beneficial. Any last minute comments before we wrap up?
No, that's fine. Thanks for listening, everyone. Hope you enjoyed it. Have a great day. Okay, John, and from you, John?
No, I'm good. Thanks. Thanks,
Excellent.
everyone.
Okay, everyone, thank you. See you all again next week. Talk to you soon. Bye bye now.